Good evening, and thanks for joining us tonight. My name is Jason Drummy. I am an investment assistant at Aquest Wealth Strategies. We're excited to today invite Oliver Herring from BlackRock. Tonight, Oliver will share his perspective on recent market activity, key macro trends, and what investors should be watching over the coming months. Oliver is an investment strategist on BlackRock's investment and portfolio solutions team, where he helps deliver market insights and portfolio ideas. Before this role, he worked on BlackRock's ETF capital markets and hedge funds solutions team. Oliver, thanks for joining us. I'll hand it over to you and open up at the end for questions.
Perfect. Thank you very much, Jason. And hello, everybody. Very happy to be here. I'm going to go ahead and share my screen. Hopefully, Jason, I am seeing a screen sharing issue, so I can chat a little bit while we're getting that enabled.
Go ahead and try that
Yes,
again, Oliver.
try it again. Perfect. Thank you very much. There we go. Let me know when you're able to see that.
Yep, looks good.
Perfect. Thank you very much. So as mentioned, I come from our investment strategy team here at BlackRock. And what we spend a lot of our time doing is looking at the macro economy, looking at the markets, and trying to get a sense of what's happening right now and why should advisors, why should investors care. Here you will see our student of the market presentation for July. This is a monthly piece that we produce. We put out every single month. Anyone can go and see it. You can Google BlackRock Student of the Market. And what we try to do with this presentation is really put what's happening in markets right now into a historical context. What have we seen before? What is new and unprecedented? What has history told us about what might happen in the future? And really try to take a historical lens here to better understand the environment and sort of the investment landscape that we're in today. Lot to cover. Of course, a lot happening kind of globally, politically, economically right now. And we will cover a wide variety of topics, a wide variety of sort of investments and asset classes here today. I just want to start off here by acknowledging that we had one of the best quarters in history in Q2 of this year. This was actually the best quarter since Q2 of 2020, coming right out of the COVID pandemic. And this is especially notable, I think, because stocks still declined about a percentage point in June. However, it still ended up being one of the strongest quarters on record. This was the 13th best quarter we've seen since 1950, and that's out of over 300 quarters. So really notable. What we did here on the left-hand side was we just took out those top 15 quarters since 1950. And again, this ranks the 13th at around 15.2%. You can see number one there, 23% back in 1975. Of course, as I mentioned, Q2 of 2020 is about 21%. That was the fourth best, but this is the best quarter we've had since that post-pandemic quarter there. What we most interestingly wanted to look at here is, okay, you have a really strong quarter. What does the market do 1 year after that quarter? And that tells us, does momentum tend to carry forward, or is that more of an indication of a reversal potentially? And historically, does that tell us that potentially the market will kind of slow down and a potential downturn following? And what we found here, you can see on the far right column there, 1 year return following a strong quarter across the board was very strong. Only 3 of those periods out of the top 15 had a negative 1 year following. But you look at some of these returns, especially coming out of 1997 in the dot-com, 2020, especially strong, almost 41% 1 year following that strong quarter. And what we did here on the right-hand side is we just averaged those best quarters. You get around 17.5%, and then average the 1 year following. You still get really strong performance around 16%. That's above the long-term annual return for the US stock market around 10.5%. And again, this tells us that momentum does really tend to carry forward after strong quarterly performance. And I think this is just a helpful reminder to all investors that if you're worried that you might have missed the run, you see a strong quarter and you think, well, I missed out, it might be time to sell and take some profit. It actually, history really tells us that that momentum does tend to carry on after we see strong quarterly performance like the one that we just came out of. So I do kind of want to zoom in a little bit and talk about the stocks, the companies that have been leading markets for the past few years. And that's, of course, this notion of the Magnificent Seven. What we looked at here on the left-hand side, just to start off, is how did the Mag 7 perform annually going back to 2023, and then how did the other 493 stocks in the S&P 500 compare? Starting off, look at where we were in 2023, even 2024. Just remarkable returns across the board for the Mag 7. On the right-hand side in that table, we looked at each of those companies. NVIDIA, of course, leading. Meta, Tesla, over 100%, even 200% for some of these companies. And all 7 of those companies strongly outperformed the S&P 500 in 23. Then you see that pattern kind of start to slow down in 24. Still really strong performance for that Mag 7. Look at 2025, still beating the other 493. 2026 has been complete reversal of that sort of investment theme with those market leaders. You look here, I'm on the table on the right side, on the far right. This is halfway through the year as of June 30th. Only one of those 7 Mag 7 companies, being Alphabet, is actually beating the S&P 500. The other 493 have been pretty consistent across the last 4 years, and including 2026. Look at 24, 21, 16, again 16 halfway through the year. But the pattern of the Mag 7 has just consistently sort of decreased over time relative to that other 493. And this is really due to kind of the reversal that we're seeing in that AI trade, where now these AI spenders are not just being rewarded for spending, but they're actually being sort of scrutinized for turning that spending into revenue. And that's when you're seeing companies like Microsoft, Meta, Tesla actually show negative performance this year, because there just hasn't been evidence yet that they've been able to turn that spending into revenue. But you look at something like Alphabet, really strong performance this year, the only one of those 7 beating the Mag 7. And again, I think this is just a reminder that the companies that were leading the markets for the past few years have fallen quite far behind as markets become more selective within that AI theme. So we think this is just evidence of why it's so important to remain diversified, especially when you have such strong concentration in the markets, and we'll talk about that in a minute. But particularly inside AI, as that leadership has rotated, and we'll also look at outside the AI theme as well. So perfect transition. I just mentioned stock market concentration has, really reached levels that we've never seen before. And so we wanted to look at, going back to 1970, is the top 10 companies by market capitalization in the S&P 500. What percentage of the total index do those make up? And what we found is these concentration trends really do tend to last for a number of years. You look here on the left-hand side, and each bar here is just 1 year with the percentage of the top 10 in the index. So you go back to 1970, in the mid 70s, around 30, 35%. And the orange bars here is just when it's above 30%. So we wanted to call out above 30 versus below 30 there in yellow. And then you can see through the 80s, 90s, even the dot-com bubble, we saw some increased concentration, but it was nowhere near the pattern that we've seen today. And if you look at recently in the last couple of years, since around 2022, this has been the largest increase in concentration we've seen ever in history in the US stock market. Going back to 24%, around a quarter of the index was those top 10 names. Now it's almost 40% just in a few years. We'll note in 2026 year to date, that's come down a little bit, but we're still well above that 30%. And historically, this tells us that these concentration trends really do tend to carry through and last quite a while. But what we wanted to look at, okay, what does that actually mean for return and risk in the market when you see high concentration? And what we saw on the right-hand side, again, breaking this up between years that are over 30% concentration like we're in right now and less than 30%, you see the max drawdown in those calendar years. So that's just from a peak in that calendar year down to a trough in that same year, the drawdown from that year. It's a bit higher in those concentrated years, around 12.1% downturn when the concentration is above 30 versus around 9.5, 10% when it's less than 30. And again, I think this is just a great reminder and example of why diversification is so critical. And importantly, pairing core index holdings that have become very concentrated with other sources of diversified exposures. So we've talked a little bit about this, and I think this is a question we're getting all the time. I think is definitely on everyone's mind. And this is just parallels between this AI sort of run up that we've seen since around 2022, comparing it to the dot-com bubble versus today. And I think, a lot of people tend to forget, and I certainly do as well, is just how outsized the returns were leading up to the dot-com bubble. On the left-hand side, simply we're just looking at around 6-year return periods, and in orange there is the dot-com bubble from 93 to 99, over 1,000% return in just 6 years. It's just returns you just really only see once in a generation, once in a lifetime. Of course, we all know how it ended, but the lead up and the return was just substantial. And you look at where we are with the AI boom, and it's getting a lot of comparisons to the dot-com bubble. The returns just aren't nearly the run up and that level of exuberance that we saw in the late 90s, around 570%, still extremely notable, but just nowhere near what we saw in the dot-com bubble in terms of that comparison of returns. And I think here, if you look at the right-hand side, now we actually show each of these years, compare what US stocks did, the broad index, to specifically the tech sector. And you can see first on that sort of top table on the right-hand side, we had 7 straight years of almost 20% or greater returns. That just really never happens historically when you look back at market returns. You know, if you compare that to where we are now, we've had 3 years of 20 or greater percent return. 2026, potentially could be there as well. But look at 2022, we had a sharp downturn in the bear market. These are just returns back during the dot-com bubble that were far exceed what you see today when you look at it kind of on a comparative basis. And I think the fundamental story is always a large part of it as well. And we've looked at this in past iterations of this presentation. When you look at the earnings growth, you look at the fundamentals, you look at the revenue growth and the net income growth of these companies sort of leading the AI build out right now. These are the largest, most established companies at the top of the index. That just wasn't the case in the dot-com bubble. A lot of those companies back then had not turned a profit, did not show revenue growth. It was a lot of sort of speculation, a lot of exuberance. The fundamental story could not be different today. And we've shown this a number of times in past presentations, but earnings growth has kept pace with returns today versus you look back in the dot-com bubble, the early 2000s, late 90s, earnings growth was nowhere near. You had returns way up here, you had earnings growth still flat down here. Now those have come together during this AI boom and companies are growing earnings and in turn being rewarded in terms of price appreciation. You can see that in terms of valuations as well. And again, I think this is just a fundamentally different story than what we saw in the dot-com bubble. Of course, they're going to get comparisons being sort of a tech focus, quick run up like that. But the companies leading today have real revenue growth, and the run up is about half that we saw so far in the same amount of time that we saw leading up to the dot-com crash. So I'm going to change gears a little bit. And this is, again, a topic in addition to kind of that AI bubble story that we've been getting questions a lot about. And we feel strongly that the questions are going to start increasing as we get closer to that midterm date. And that's just what markets have historically done when you're in a midterm election year. There's a number of different ways to look at it. We wanted to focus specifically on volatility. And first, what you see here is going back to 1930. So we really rich data set of market returns here. The average return has been around 7%. So we know that's below the long-term average. But history shows that when volatility is subdued during those midterm election years, returns are actually really strong. And so we wanted to look at here on the left-hand side, and sort of the metric that we used is how many trading days in each calendar year were less than -2% or greater than 2%. So kind of really large market swings on a day-to-day basis. You can see going back to 1930, a lot of volatility, 53 days, 50 days, 77 days back in 38. And then that kind of became a little bit more subdued. Through the 40s, 50s, 60s, 70s, you had some years, some midterm election years, sort of above that threshold of 10. So if it's above 10 of those days, it's going to be an orange. Yellow is below 10. And you can see it kind of bounced up and down where some midterm election years were a bit more volatile than others. But we've seen volatility pick up a little bit. First, you look at 1998 and 2002, of course, kind of leading up to the dot-com bubble, a lot of growth, and then the dot-com crash. So a lot more of those -2% days. And then you have years such as 2010, kind of coming out of the financial crisis. 2022, of course, was a bear market, and you saw a lot of negative kind of large swings. But what we've seen in 2026 so far is just 4 days of greater than or less than a 2% swing. One in January, one in March, one in April, and then one in June. And you can see that January was a downturn, really strong couple days in March and April, and then another downturn in June. But what this tells us is that we haven't seen so far in the first half of this year the level of volatility that we've seen in some of those past midterm election years. On the right-hand side, again, we're just kind of taking averages now. So in the days, in the years where there were more than 10 of those kind of large swings, performance was actually negative, around negative 1%. Look at the difference when you had 10 or less of those days, almost 20% returns. I mean, when we looked at this data, we almost had to double check it just to make sure it's correct because it's such a different swing between when you have that high level of volatility and when you don't. And this has no doubt been a volatile and eventful year for markets, but we just haven't seen those large sort of single day reactionary swings that we've seen in midterm years past. And so this, I think, is just another really interesting kind of example and reminder that the important thing is to stay invested and avoid that temptation to time the market, whether it be around political events, around volatility. And it just is another reminder of staying disciplined and staying invested through these different market cycles. So here is another really interesting slide that we wanted to include this month. And just, I think it's really interesting because of the length of time that we're looking at here. Going back to 1926, so we're at 100 years of stock market data. And really what we're looking at here is kind of the concept and the importance of risk management and managing those downturns among market cycles. So you'll see two lines here on this chart. The first is orange, and that's just the S&P 500. You start with $1,000, you stay invested for 100 years, you'd end around 23.7 million. Now, if you took those exact same returns, but you managed the risk so that you'd have 85% capture of bull markets and 85% capture of bear markets. This is the upside downside capture, 85%. So an example being, say you had a run up of 100%, you would capture 85% of that. You'd be 85% for that duration. And it's same for the downside. Stock market drops 100%, or 10%, you would capture 8.5% of that downturn. And really what you see is over the long term, adding that element of risk management on both the up and the downside. So you're not capturing 100%, but limiting the downside, you're also limiting your upside. Your ultimate ending returns are still higher than if you had held at 100% throughout that entire period. And I think here kind of the key understanding is the benefit of risk management, diversification, and managing that downside risk. It's kind of counterintuitive sometimes where you think that getting more of the upside but also taking more of the downside will be beneficial in the long term. And the data just really doesn't support that. And you're actually better off over time, in terms of building wealth, building long-term investment portfolios when you think about this approach, when you have that sort of risk management mindset. So I think another topic and another theme that we've been seeing in the last few years is this kind of correlation between stock and bonds, and more specifically, kind of the efficacy of bonds as a diversifier in portfolios. It's been a really interesting kind of pattern for the correlation between stocks and bonds. And I think here on the left is a way to outline that. This is the 3-year rolling correlation between stocks and bonds. And I'd like to point out that in January of 2025, we hit an all-time high in history. We went back to 1929 with this data, and we see that 0.72, the correlation between stocks and bonds, is the highest we've ever seen. We got close back in 1996. We got close all the way back in 42. But 0.72 is the highest 3-year correlation that we've ever seen among stocks and bonds. Now what we're seeing is that's starting to come down a little bit. And you'll probably notice here on the chart on the left, this really tends to come in cycles. You'll see peaks, you'll see lows, you'll see it fluctuate up and down. And so these cycles really tend to come and go. But in January, the beginning of 2025, that was the highest correlation we've ever seen for stocks and bonds, meaning that we'll look at this on the right-hand side in a sec, but meaning that when stocks fall, bonds also tended to fall more often. And that means bonds just weren't the traditional diversifier that they've been in portfolios, historically. We looked at some specific downturn months here on the right-hand side. And this is going back kind of in the midst of that peak 3-year period. So this is through 2022 to the end of 2024. Really interestingly, the pattern that we saw here is the 14 months from 2022 to 24 that stocks lost money, bonds also lost money. And this tends to be the longest streak in history that we saw there. Every time that stocks fell in a month, bonds also fell in the month. Now, as I mentioned, that pattern has started kind of reverse where correlations are improving. We're down to around 0.5. And recently, a few of the months that here we just pulled out 6 here on the far right hand side, where stocks were negative, bonds actually ended up being ballast and being positive performing in portfolios. So this kind of tells us, after historically poor defensiveness for bonds, their ability to provide ballast in portfolios is starting to come back. But I think what this highlights is kind of a new regime where diversification cannot just come from bonds anymore. You need to think of kind of different sources of diversification, additional forms of diversifying portfolios, and as we've seen, these correlations can really swing over time, and that's why it's so essential to build a portfolio that doesn't just rely on bonds for being the primary diversifier. And so I'll just close out here talking a little bit about alternatives and alternative strategies. And something really interestingly, the pattern that we've seen is alternatives have done well when interest rates are high. We know the Federal Reserve is expected to keep interest rates at least unchanged, or the market is potentially pricing in hikes this year and into next year. But this is a backdrop that's really, supported these kind of liquid alternative type investments. What we looked at here is when rates are above 3%, of course, as they are today, and when rates are below 0.5%. And we just split that up. We looked at cash, we looked at bonds, but then we looked at 4 of the most popular kind of liquid alternative categories. These are just Morningstar categories. You have macro trading, you have equity market neutral, you have multi-strategy, and you have tactical allocation. And each of these, the ones that we looked at, are the average annual returns when interest rates are above 3%. Are in some cases substantially higher than when they're below 0.5%. You look at equity market neutral, you look at multi-strategy getting over a percentage point, almost percentage point and a half higher returns. Even tactical allocation, really strong returns on both regards, still higher when rates are above 3%. And then, of course, you see cash, you see bonds. That's kind of more of the traditional story. But liquid alternatives follow that pattern as well. And so, here at BlackRock, we think the Fed is going to remain on hold for quite a while, at least probably through the end of this year. And higher rates really can be a tailwind for alternatives. It creates an environment with more dispersion. Sophisticated managers are able to take advantage of that dispersion. And you also have higher returns in these funds that are sitting on idle cash kind of as they're waiting to be deployed. So alternative strategies really can provide that differentiated source of return and diversification that's so critical in portfolios today, especially as bonds really haven't done what they've historically intended to do. So I'll just wrap us up here. We talked about how we had a really strong quarter in Q2, but that momentum historically tends to carry on. But the Mag 7 and these kind of mega cap, large AI names just really aren't leading markets like they've done in the past few years. That being said, we do still have pretty historic stock market concentration, kind of why diversification is so important. The dot-com bubble, is getting a lot of parallels to where we are today, but it's just a fundamentally different story. And I think midterm election is another story that's going to get a lot of attention. And what we see is that when volatility is subdued, stock market performance does tend to be pretty constructive there. So I'll pause there. Jason, I'll pass it back to you, and happy to answer any questions here.
All right, Oliver, thanks. That was great. I do see one question in the chat right now. It says,